So today's Cardinal lesson, we're talking about life insurance at 65 or at retirement or in your 60s. And first thing that people are thinking is, man, I don't need life insurance at 65. I mean, I just at retirement, my home's paid for, the kids are grown up and out of the house, and I had term insurance or I have term insurance, but it's going to expire. What in the world are you talking about life insurance at age 65? And so, what we're going to do in this example today is we're going to show you $100,000 worth of life insurance on both a male and a female at the standard rate. And we're going to show you some examples. And in the show notes, we're going to get down and provide for you, if you want to click on those, all the details. But before we get into all that, what I'd like to do is I'd like to bring Tom on, and we're going to talk about, we've listed 4 situations that people, when they're 65 or they're at retirement, they're this age, need and want life insurance. And really, and then kind of a fifth thing that applies to this where life insurance can be used while you're alive. So the first one I want to talk about is a couple. And when couples is when we're doing estate planning or financial planning and we're planning the whole of your retirement, it's pretty much a given that with most couples, one of them is going to die before the other. And sometimes people think they know which one that is, but you really don't know who that is. And you could die at the same time, but more than likely, one of you is going to die first and the other one's going to live on. And if that's for a long period of time, that creates some problems very specific to couples. And one of those is immediately after a person's death or the next year, they're a single tax filer. And if you've ever compared tax brackets and how wide they are for the 22% levels and the 24% levels and so on and so forth for couples, those things cut in half, or tax rates go up significantly for a single person. So when we're planning and we're doing our tax planning for that survivor, they're going to pay a higher percentage of their income in income taxes. And really, the second thing with that is the survivor is going to live on with a larger Social Security check, and the smaller one is going to go away. So, Tom, what have you got to say about this?
Yeah, and I think one thing I can say definitively with all couples is if one of the spouses dies before the other, there will be a reduction in their income. No matter what you do, not saying they can't, account for that, but one of the social security checks goes away in every scenario when there's a couple. That is made worse if they have a pension that doesn't have like a survivorship benefit there too. And so we've run into many cases where people have a really large reduction in their income when the first spouse dies. And so this idea that I don't need life insurance because, maybe these big things are taken care of, the house, the kids, those type of things, isn't always true. I mean, there's a lot of situations where you will need some life insurance to make sure your spouse is okay when you pass away. And I think the lower tax brackets make things worse because, expenses go down a little bit when the first spouse passes away, but they don't get cut in half. And now we're having to live off of lower income at higher tax rates. That's less money for them to live off of. And so this is something that really we need to consider. And it's not saying that everyone needs life insurance, but to dismiss it completely, I think would be wrong.
Yeah, so the survivor of a couple, life insurance benefits are tax free. And so to just have an infusion of money that's tax free that we can generate an income from, and you can pay some final expenses, having some life insurance for the whole of your retirement is nice. And so we'll get into the benefits and the costs a little bit later. Now let's talk a little bit about a lot of couples that we're doing retirement planning for are in second marriages, and they have children from their prior marriage or their first marriage. One of them does, both of them do. And this is an issue because a lot of people, they need to leave the assets at the first death to the spouse. And they may have commitments to their children, at least in their heart, or they may have spoken those commitments when they got married in their 50s or 40s, of some of the accumulated wealth or their IRA or their 401k they may have their kids as beneficiaries. And that presents a real problem when we're doing financial planning, assuming that the surviving spouse is going to get the 401k or the IRA money of the person who died or the spouse that died. And then if we just change the beneficiaries and take care of the spouse, that leaves the kids or the stepchildren of the survivor um, out out of the will. So life insurance is a wonderful solution for that, and it doesn't even need to be a huge amount where you would make the kids the beneficiary, and then you can throw the assets at the spouse, or you'd make the spouse the beneficiary of a larger life insurance policy. They're going to get it tax free, and you leave the IRA to the kids, or some combination of the two. So there's life insurance is a great tool because we can create an immediate estate just with the stroke of a pen. I mean, what do you have to say about that, Tom?
Yeah, I mean, I think it's a great point, and we see this often where there's marriages, second marriages, and they have kids from prior marriages. And when they were coming together, they made promises to their kids. I mean, they really wanted the money that they accumulated before the second marriage to be for the kids. But in reality, they also love their current spouse. They're still married. They need to leave financially, need to leave the money to the spouse so they can continue on living in their standard of living they're used to. And so life insurance is a great way to have additional money come into the estate where we can take care of the kids, make sure they're taken care of, which is part of the wishes that you had for them initially, but also make sure the surviving spouse is taken care of if you predecease them. And again, life insurance is just a great tool to do that with.
Okay, so then let's talk about insuring an IRA, just in principle. Is that people in their 60s, a lot of them, well, first of all, many people in their 60s need money out of the IRA to live or the 401k, and they're going to roll it over. We help people with that all the time. Now, that's a lot of people. But then there's the people, sometimes they're single, sometimes they're married, and they just don't need money out of the IRA. So they have the luxury of postponing the required minimum distribution or RMD problem till they're 73. So they're not even thinking about it. And then until they come see us, we're going to get them thinking about it, because this problem is going to hit you in 8 years if you're 65, is you're going to have to take some money out of there and pay taxes in it. But still, you're setting yourself up if you're saying that your IRA is really to go to your adult child or both two children, or your niece or your nephew or your church or somebody. Well, the church won't have to pay taxes, but if you're setting yourself up where you've just got all this untaxed money and it's growing and growing and growing, and then you pass away, you're going to be handing your beneficiaries a tax problem. Let's just put it that way, a big tax problem. And so because life insurance goes to beneficiaries tax free, we have a lot of people that go on this strategy where they will insure the IRA. They'll start taking out enough in a distribution every year, plus the income taxes that they got to pay. They'll do that every year for several years, which draws down the IRA, and then it immediately has the life insurance benefit, so that when they pass away, their kids or whoever their beneficiary, their spouse, is going to get that amount, which was the size of the IRA, tax free. I mean, it's a great way to insure a estate. And frankly, I have some people who have a desire to leave money to an individual or to a group of individuals, and they really don't have any significant assets to pass. So they don't even have a big IRA, but yet they can afford to buy something like this and pay the premiums out of their income. And it's a bit of a savings account for them. And then when they pass away, it's just creating an immediate death benefit. And then the last one that we're going to talk about is to leaving an estate, a tax-free estate, privately and directly to a beneficiary. So why don't you speak on this one, Tom?
Yeah. And so one of the things that, we run into oftentimes is when someone dies, they might have this wealth they've accumulated and they have not set things up properly. And it takes a while for their beneficiaries to receive that money. And so they told us years ago, we don't need life insurance. I have this money. They'll get it when I die. Well, 6 months later, the kids still don't have the money after death. One of the great things about life insurance is it passes almost right away after the death. And so you provide a death certificate to the life insurance company and they send it directly to the beneficiaries. It's outside of the probate. It goes directly to them very quickly, right as the kids need the money. And so, of all the things that get passed, it's one of the easiest assets to pass along to the beneficiaries at death, and it's very smooth. Whereas even with IRAs that have properly titled beneficiaries, there's different accounts that have to be open. You have to set it up properly. I mean, it's a little bit of work you have to do to even get through all that. Not to mention if you haven't set up the beneficiaries properly, it's a whole nother ballgame at that point.
Sure. And then the last feature that we have on here is these modern life insurance policies. When I say modern, in the last 10 years or so, most of them, and the ones we're showing today, have these benefits. They have a critical illness rider, they have a chronic illness rider, and they have a terminal illness rider. And all those simply mean is you can access your death benefit while you're still alive. So if you were need to use care, if you need somebody to take care of you at home, or you need to go into an assisted living and receive care through the chronic illness rider, you can access your death benefit. Now, $100,000 of death benefit is not going to be enough to pay for it all from that rider. So you'd need to buy substantially more if you were going to develop insurance to cover care, if this was going to be your primary deal. But this is a nice benefit. And the critical illness factor is usually if you had a heart attack or a stroke or something, and you needed money because of that, you can access a significant portion of it. And the terminal illness, you can access almost most of it. So these living benefit riders are a great way to use life insurance to provide benefits that we would sell other types of insurance for. And the nice thing about them is they come to you tax free. So what we want to do now is really go over the top of the board and talk about this $100,000, these $100,000 examples. So what I've got here on the top is we've got a female and a male buying $100,000 worth of life insurance, where they're paying the premium for 20 years and they are stopping the premium at 85, but they still have the insurance here till 100. Okay, in both places, they have the insurance till 100, but this is the least expensive way to buy $100,000 worth of life insurance. And it's a policy that is not designed to build much cash value that you could actually access. And what we have down here is the same $100,000 life insurance policy to start. So you could really look at the difference between these two premiums. And it's designed for maximum cash value development and maximum growth in the death benefit of the life insurance, both on a female and a male. So what I want to do is go to the show notes and I want to show you where you can find the illustrations. I'm going to let Tom walk you through that, where you can find the illustrations that give you the whole details of this.
Yeah, so you can find these show notes. They're on a link below the video on YouTube. They're also on our website. So that's where you can find them. The front page is just a picture of the board with some disclosures here, but we'll get into the illustrations. There's 4 in total. We're going to throw through them very quickly because we don't need to go over every detail here. But I'll kind of refer back to the board to let you know which sort of section we're talking about on the board. But the first one we're going to look at is this top left section of the board. This is the female at 65, the 100,000. That's really not designed to build much cash value. This particular company is Midland National. It's not the only one that offers this type of policies. It's just an example. Another thing to know is there is some underwriting components to these policies. So this would be based off the standard rating. They have preferred rating, could be less expensive. You could get rated, it could be more. So pricing is specific to your situation and age and could be state. But for this person, this is a 65-year-old female. And you can see the premium stays level at $305 a month for 20 years, and then it stops. There's no more premiums after the 20 years. The account value really isn't designed to grow much in account value, so that just is pretty low for the life of the policy. But the death benefit is the same 100,000 for the life of the policy, and it goes all the way to age 100. So you stop paying premiums at 85, the policy continues past that point. So it's designed to last your whole life, with the lowest premium possible to do that. We're going to go down to the next one is sort of that top right section of the board. This is the same type of policy except for the 65-year-old male. You can see the price is a little bit more expensive, $381 per month. Men are a little more expensive to insure under life insurance policies, but all the benefits are the same 100,000, same 20-year premium. Again, account value doesn't really grow up by much, and then again the death benefit lasts all the way to age 100. The next ones, and let's see if we can get down here, is this will be the bottom left section of the board. This is the female 65-year-old. This is with the company Penn Mutual. Again, there's other companies that offer this, but this is a whole life policy that has dividends. And so this one is designed to build a cash value over time. And so it is a little more expensive. You can see the annual premium is $5,300 a year. Same 20-year schedule, so a little more expensive. It lasts for 20 years. The premiums stop at 20 years. The biggest difference between this policy and the Midland National policy is it has dividends. That the way we've illustrated here is they're buying paid up addition to the policy. So one of the features is you can see the total death benefit actually increases over time. And so it starts out at 100, but by the time we get to year 20, it's projected to be out closer to $158,000. There is cash value growth in this policy. And so the cash value, again, this is non-guaranteed, but assuming the dividends pay out this way, the cash value is $130,000 based off this premium you've paid into the policy. And then even once a premium stop in the 20-year, it still continues to grow past that point. And so what's nice about this type of policy is you're able to access that cash value not only for those critical illness and terminal illness and the ones that Hans went over, but you could take a loan on the policy for any situation. Do we get to year 20, you need some money, you can pull it out via a loan and not pay taxes on the loan. How that works is the death benefit when you eventually die is pay back the loan balance. So don't do this on your own. We would help walk you through how that would work. But this has the ability where you can access the cash value for yourself during the life of the policy.
Yeah, so what we wanted to do with the specific illustrations, so that we're not just throwing a few numbers up on the board, is those show notes are going to add context. But the thing I want you to note here is for this female, this lady who's 65, at the standard rate, about $300 a month, she buys a $100,000 policy, and she's not interested in the cash value. She just wants a whole life insurance policy that's going to be there when she passes away. And she doesn't have to pay on up into her late 80s and 90s. So we stop the premium after 20 years. But it doesn't matter when she dies, after the policy's issued, it's going to pay $100,000. And she doesn't really care about cash value, and she doesn't want to pay for it. This policy is more of life insurance as an investment and a death benefit. So you're always buying life insurance for the death benefit. That's why you're the main purpose that you're buying it for. But while you're doing that, there's several tax advantages of paying additional premium. And this shows you a whole life policy where it's $53.32 a year, which is like $450 a month or so. So it's almost 50% more in premium. But if you start running an analysis, or we do this all the time, on the cash value development, at age 85, she's got 130 grand of cash value built up in there through the combination of the cash value and then leaving the dividends in there over those years. And if she is still alive at 95, and she hadn't paid any premium from 85 to 95, because the premiums stop here too, she's got almost $200,000 of cash value. And I don't imagine too many people would be cashing that in, but if she needed to, she could. And a death benefit of $216,000. So This lower policy is going to be more expensive. It's going to accumulate cash values that you can access during your life. And then it is also going to grow in face amount to ultimately go to the beneficiaries. And this, I want you to keep in mind, over on this side is the male, but I want you to keep in mind is we're showing 100,000 and we're showing it at the standard rate. But if you're interested in 500,000 or a million or 200,000, you could pretty much just multiply these numbers times 2 or 3 or 4, the numbers on the illustration. And it's going to be a little bit less if you buy a lot of it than the 100,000 price, but not significantly. So this gives you an idea of how we can move the money around. And if you really wanted to see a different amount or perhaps some different companies to compare, you just give us a call. We're in all 50 states in the District of Columbia. I want to talk a little bit about the standard rate because like the standard rate is what guys like me get. I got high blood pressure, I got cholesterol, I'm overweight. And so I have to work a little bit to get standard, but that's a pretty wide range of people. You can have some things and still get a standard rate. Now, if some of those things are serious or they're out about, then you're going to start paying more than these rates. But as Tom mentioned earlier, there's a preferred rate and then there's a super preferred. So, and it's just the better health you're in and the better health history, this can be less and significantly less than either of these numbers. So it's a good idea to look at this. You may already have life insurance in force, and you're talking to us about dropping it. And we have a lot of people that we're going to sit down there and we're going to try to figure out how to keep that in force or keep the right amount of it in force. If you have term insurance that's expiring, we're going to see if it's convertible and maybe convertible for a smaller amount. Maybe you don't need as much as you carried all your life, but you need something. So we work with people in this, and we have about 50 companies, different companies at our disposal to work with for these types of life insurance. So what I want to go over are the 7 worries that we talk about in all of our videos. And today we talked about Social Security or replacing a Social Security check. We talked about long-term care benefits or chronic illness benefits, where you can access your death benefit of your life insurance policy to pay for those. We talked about IRA 401k, that we have many people that start distributing their 401k or their IRA to themselves, paying the taxes, using what's left to buy a life insurance policy, so their beneficiaries will receive a tax-free benefit at their death. We talked about income, because you can actually set these policies up so that later in retirement you could produce a tax-free income for the rest of your life. This whole show has been on estate planning and life insurance. And then, of course, we're always talking about taxes and the tax advantages of this kind of stuff. So with that being said, I want to bring Tom back on. I want to thank you very much for listening.
Thank you.